Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Ouster.
If you find our talks useful, please consider subscribe, like, and comment underneath. And remember to check out the VIP Algos link below in the description.
Yeah, it's a great tool. You definitely want to check that out.
So getting right into it, there is this wild paradox happening in tech right now. We spend so much time talking about artificial intelligence as this invisible, omnipotent brain, living in the cloud. We watch it write code, draft legal briefs, master these complex games.
Right, like that recent match where human grandmaster Shinjin Seo actually outmaneuvered the top Go AI, Katago.
Exactly, which caught a lot of people off guard.
Oh, absolutely. For a while there, the consensus was just that machines had permanently conquered those closed-loop board games. It really proves that creative human strategy still has a place in those highly defined, strictly rules-based environments.
But here's where it gets really interesting for wealth building, because while we're all debating whether a human can beat a neural network on a little 19 by 19 grid, we are completely ignoring a much, much harder problem.
Yeah.
How do you get that brilliant AI brain to, walk across a messy, unpredictable, real-world street without tripping over a curb or getting hit by a bus?
You're hitting on the single highest hurdle in technology today, the transition from digital simulation to physical reality.
Mm-hmm.
It is one thing to calculate probabilities in a server farm, right?
Yeah.
It's an entirely different beast to process the chaotic physical geometry of a city block in real time.
And that context is exactly why we're looking at Ouster today, ticker symbol OUST. We're unpacking the explosive structural boom in what is now being called physical AI.
Because at the end of the day, an AI without eyes is basically just a really smart calculator trapped in a dark room.
Right. It needs sensory organs. If you want autonomous robotics, self-driving industrial vehicles, or, smart infrastructure to function outside of a computer, they absolutely need robust spatial data.
They need to map the physical world in 3 dimensions, down to the millimeter, multiple times a second.
And as anyone following the physical AI boom knows, that is the entire premise of LiDAR. But looking at the broader market, Ouster isn't the only company making these sensors.
No, they aren't.
Yet they are heavily dominating the conversation right now. Let's get into their fundamentals, because it seems to come down to a massive structural difference in how they actually build these units compared to legacy players.
Right. So to understand their competitive moat, you really have to look at the physics of the hardware. Historically, legacy LiDAR systems were analog and highly mechanical. They relied on these discrete lasers and individual detectors that literally had to physically spin or move to scan an environment.
Oh, if you picture those old, bulky spinning buckets on top of early self-driving cars, that's what we're talking about.
Exactly. That's the legacy tech.
Which, mechanically speaking, sounds like a nightmare. You have moving parts, friction, wear and tear. If a robot is operating in a warehouse or a truck is driving over potholes,
those delicate spinning lasers are going to degrade or just break.
Right.
They are highly expensive to build, highly fragile in the field, and incredibly difficult to scale. But what Ouster did was shift the entire paradigm. They completely abandoned the mechanical spinning architecture.
Okay, what did they replace it with?
They moved to digital LiDAR technology, utilizing standard CMOS silicon processing.
Okay, wait, let's unpack this for a second, because the term CMOS gets thrown around a lot. If you're wondering what CMOS actually means for their bottom line, think of it this way. Standard CMOS processing is the exact same manufacturing technique used to mass-produce the microchips in your smartphone.
Yes, or the image sensor in your digital camera.
Right. So building legacy mechanical LiDAR is like sitting at a workbench, hand-building a bespoke mechanical clock with hundreds of tiny custom gears. It takes time, it's expensive, and every piece is fragile.
It's artisanal almost.
Yeah, exactly. Whereas Ouster's approach is like printing 1 million microchips on a silicon wafer in a massive automated fabrication plant.
And by moving the complexity from physical moving parts onto a solid-state silicon chip, they fundamentally alter the unit economics of the industry. They achieve a massive cost advantage.
Oh, wow.
And more importantly, a scalability advantage. When a robotics company suddenly needs 10,000 sensors for a new fleet of delivery drones, a mechanical LiDAR company has to hand-assemble 10,000 delicate clocks.
And Ouster just fires up the silicon printer.
Exactly. And that manufacturing efficiency creates a serious moat. But technology isn't their only fundamental advantage. We have to talk about Velodyne.
Right, because they didn't just out-engineer their competition, they bought them.
The merger with Velodyne was a watershed moment. When you were operating in a nascent hyper-growth industry like physical AI, consolidation is the name of the game. Velodyne was an absolute pioneer in 3D surround LiDAR.
So by executing that merger, Ouster didn't just eliminate a rival. They unlocked aggressive cross-selling opportunities, right? Pitching their software stack to Velodyne's legacy hardware clients.
Yeah, and they realized incredible operational cost synergies by combining overlapping departments.
I was looking at the actual assets they acquired in that deal, and the patents are staggering. They absorbed a formidable portfolio of hundreds of foundational patents.
Which is massive.
Yeah, to me, that creates an intellectual property moat that makes it nearly impossible for a garage startup to just swoop in and copy their homework without paying a massive licensing toll.
Plus, there's the switching cost mode.
Right. What does that look like in practice?
Well, the switching cost is arguably their strongest asset. Once an industrial robotics company integrates Ouster's digital LiDAR into their physical AI stack, they write millions of lines of custom code to interpret that specific data feed. They calibrate their entire robotic fleet to Ouster's exact hardware specifications.
Ah, I see.
Ripping all of that out to start over with a slightly cheaper competitor is a logistical nightmare. The integration is just too deep.
Which brings us to a fascinating disconnect in the financials, because having incredible, highly integrated technology is one thing. Building a sustainable, profitable business around it is another.
Very true.
Let's look at the actual balance sheet, because the trailing 12-month numbers are wild. Their revenue growth is sitting at a blistering 57.34%.
That is incredible top-line acceleration for a hardware company.
And their gross margins are exceptionally strong at 48.99%.
Which goes right back to that CMOS silicon manufacturing advantage. When you are printing chips rather than hand-building mechanical lasers, your hardware margins start to resemble those of a high-margin software company.
Keeping nearly 50% of your revenue as gross profit gives you immense flexibility.
It really does.
Okay, but here's where I have to play the skeptic, because the math is conflicting. If top-line revenue is up over 57% and they are keeping almost 50% of that as gross profit, why is the company's net margin sitting at a negative 30.12%?
Yeah, it looks bad on the surface.
Their earnings per share, their EPS, is negative 96 cents. They are printing money on the hardware, but as a total business, they are bleeding cash. Why?
You are looking at the classic cost of hypergrowth. It is the fundamental difference between gross margin, what they make on the physical product, and operating margin, which is what it costs to run the entire company.
Okay, so the operations are dragging it down.
Right. Yes, the LiDAR units themselves are highly profitable. But physical AI is a market that is being built from the ground up today. To capture that market before anyone else, Ouster has to spend massively on research and development. They have to hire top-tier software engineers, deploy global sales teams, and build out international distribution networks.
So they are aggressively choosing to operate at a loss right now to lock up the global market share. They are basically buying the monopoly.
It is a calculated burn rate. And if you dig deeper into those financials, their operating losses are actually narrowing quarter over quarter. They are scaling their revenue much faster than their operating expenses are growing.
Oh, operating leverage.
Exactly. The heavy lifting of the R&D and the Velodyne merger integration is starting to pay off. That is why the market is assigning them a price-to-sales ratio of 11.94.
Which, for a traditional legacy hardware company, would be absurdly high.
But entirely reasonable for a hyper-growth AI leader prioritizing aggressive market capture over immediate profitability. Investors looking at Ouster today are not buying the stock for a quarterly dividend check. They're buying the base layer infrastructure of tomorrow's physical world.
And to fuel that infrastructure build-out, they just pulled off a massive capital raise. They completed a public offering of 3.62 million shares at $55.22 a share, netting the company approximately $191.9 million in fresh capital.
Strategically speaking, raising capital when your stock is performing exceptionally well is exactly what a prudent management team should do. You sell into strength to secure your balance sheet.
That brings their pro forma cash position, the cash they have on hand post-offering, to around $375 million. That is a massive war chest for a company of this size.
It allows them to aggressively reinvest in that R&D and scale their operations for massive global deployments without having to tap into restrictive, high-interest debt markets. Having $375 million in pure cash is a massive structural advantage right now.
So they aren't going bankrupt anytime soon?
Definitely not.
But, we should transition to the upcoming catalysts because the market is really looking forward to seeing how they deploy that cash.
Absolutely. Everyone is going to be hypo-focused on exactly that deployment when Q2 2026 earnings drop in August.
Right. The focus won't just be on the backward-looking sales figures. Institutional investors are going to be scrutinizing management's forward guidance. They want to see the tangible path from pilot programs to large-scale, multi-year commercial deployments.
Which leads us perfectly into the most compelling speculative catalyst out there right now. There is a massive, unconfirmed rumor circulating about Ouster's upcoming deployment.
Oh, the 2026 World Cup rumor.
Yes. If this proves true, it completely changes the scale of their municipal footprint.
Yeah, unconfirmed reports suggest that Ouster's digital LiDAR sensors are being quietly integrated for crowd management and smart infrastructure across the global event.
Think about the logistical nightmare of the World Cup. You have millions of people speaking dozens of different languages, moving simultaneously through stadiums, transit hubs, and foreign city centers.
It is arguably the ultimate real-world stress test for physical AI and smart infrastructure.
And here is where the why becomes so important. If you are a municipal government trying to track crowd density, prevent deadly bottlenecks, and manage security in real time, you could just put up thousands of traditional cameras.
But traditional cameras have massive blind spots, they struggle in poor lighting, and most importantly, they capture faces.
Right. In an era of intense European and global privacy regulations, deploying mass facial recognition is a political minefield.
But LiDAR solves this mechanically right. It maps the environment in 3D, turning every human into a cluster of moving pixels. It tracks the flow of the crowd flawlessly without actually identifying the individuals.
It strips out the privacy concerns entirely while delivering superior spatial data.
Exactly. If Ouster is indeed powering this event, it acts as a multi-billion-dollar global commercial. Imagine being the Ouster sales team after the tournament ends. You walk into any mayor's office in the world and you say, "We manage the physical flow of 3 million people across 16 different host cities without a single glitch or privacy lawsuit."
The potential for unannounced municipal contract wins post-tournament is just staggering.
So the fundamentals and catalysts look incredible, but let's shift to the technicals. Because the mechanics of raising that capital didn't come without some serious whiplash for the stock itself.
Oh, Wall Street is treating this ticker like a roller coaster right now. The price action is intense.
Yeah, currently the stock is trading at $39.61. Just today, it printed a massive daily rebound, up a sharp 13.92%. But if you zoom out to a 5-day period, it's actually down 17.15%, having dipped down to $36.11. I assume that sudden drop was the immediate reaction to the share dilution from the public offering.
Precisely. When a company issues 3.62 million brand new shares to raise that $191 million, they're increasing the total supply of shares on the market. It dilutes the ownership percentage of existing shareholders.
The pie gets sliced into smaller pieces, so the value of each slice temporarily drops.
Exactly. A short-term 17% drop following a major secondary offering is entirely standard market mechanics.
But the broader momentum is what's really catching my eye. Even factoring in that 17% dilution drop, the stock is still up 60.67% year-to-date. It's currently sitting about 38% below its 52-week high of $63.79.
In technical analysis, that kind of price structure suggests the broader macro trend remains heavily bullish. That recent dip down to $36 likely represents what momentum traders call a higher-low technical setup.
So smart money is stepping in to buy the dilution dip.
Yeah, the fact that it rebounded almost 14% today on higher-than-average volume indicates aggressive institutional support.
But we have to talk about the beta because this is crucial for anyone trying to understand how this stock behaves. Ouster has a beta of 3.33.
That is extremely high.
Right. For context, beta measures how violently a stock reacts to the broader market. A beta of 1 means it moves in perfect sync with the S&P 500. With a beta of 3.33, Ouster isn't just riding in the passenger seat of the tech market, it's strapped directly to the hood of the car.
Exactly. If the broader market hits a tiny speed bump, Ouster feels it in its teeth. It is highly sensitive to market rotations and momentum shifts.
Which perfectly explains the most fascinating piece of institutional plumbing we are seeing develop around this company right now. Defiance ETFs just launched a brand new exchange-traded fund specifically targeting Ouster stock. The ticker is OUSL.
And it is a 2x leveraged single stock ETF.
I had to read that multiple times to make sure I was seeing it right. We see ETFs all the time that track the entire S&P 500 or the whole semiconductor sector, but Wall Street just built an entire 2x leveraged ETF around one single, highly volatile, unprofitable LiDAR company. To me, that signals they aren't just treating this as a tech stock anymore. They are treating it like a casino for the entire physical AI boom. Am I reading that right?
You absolutely are. And the structural plumbing behind how a 2x leverage ETF actually works is critical to understand. To deliver double the daily return of Ouster's stock, the fund managers use complex swap agreements with massive investment banks. They rebalance their exposure every single day.
Creating a mechanical feedback loop.
Right. If Ouster's stock goes up, the ETF has to mathematically buy more exposure to maintain its 2x leverage.
So the very existence of the ETF forces structural institutional demand into the market. It creates a baseline of continuous trading volume.
And beyond the plumbing, the creation of this product validates the narrative. You do not go through the headache of launching a single stock leveraged ETF unless massive institutional clients are demanding a vehicle to aggressively trade the volatility of that specific story. Wall Street clearly sees Ouster as the premier vehicle to trade the physical AI transition.
Which brings us right to market sentiment. The quantitative metrics are rating Ouster as an 8 out of 10 right now. Strongly bullish. The narrative has definitively shifted. For the last 2 years, all the capital was flowing into software AI, the chatbots, the large language models. Now the market is asking, what happens when these models get a physical body?
And the analyst community is actively repricing the stock based on that shift. We are seeing major firms upgrade their models. Oppenheimer analyst Colin Rush recently maintained an outperform rating, and he significantly raised his price target from $42 all the way up to $57.
That is a massive vote of confidence, especially coming right on the heels of their capital raise.
He is clearly modeling out how they are going to deploy that $375 million war chest.
Okay, we've laid out a very compelling bull case, an 8 out of 10 sentiment score, a massive cash pile, an unmatched digital CMOS moat, and the World Cup speculation. But we have to explain the downside clearly. Let's look at the risks and the bear case.
Right. No stock is immune to gravity, especially one operating with a beta of 3.33.
If we look at the macro board, there are severe structural execution risks that could derail this entire thesis. Let's start with the immediate geopolitical risk.
You cannot talk about hardware without talking about the global supply chain. And right now, the geopolitical landscape is incredibly fragile.
We are currently seeing reports of the 10th consecutive night of U.S. strikes on Iran, with retaliatory attacks aggressively threatening major global shipping lanes. Now, to be crystal clear, we are not taking any political sides here. We are strictly looking at the mechanical impact these conflicts have on the global flow of goods.
And mechanically speaking, this is a critical vulnerability for Ouster. We spent the first half of this talk praising their transition to standard CMOS silicon processing. But that manufacturing model relies on a highly globalized supply chain.
Right. Those silicon chips are likely fabricated in Asian foundries, assembled in Southeast Asia, and then shipped on physical cargo vessels through specific choke points in the Middle East to reach Western markets.
Exactly. If a conflict shuts down the Red Sea or the Suez Canal, those cargo ships have to reroute thousands of miles around the Horn of Africa.
Which means the time it takes to get components increases by weeks, and the cost of a shipping container skyrockets.
For a hardware company, any disruption to those physical choke points hits manufacturing directly. It delays their ability to deliver finished LiDAR units to clients.
Now, they do have that recent $191 million capital raise, so they have the pure cash to absorb the inflation of those shipping costs.
They can weather the storm without going bankrupt, yes. But remember that beta of 3.33. While the underlying business has the cash runway to survive a global supply chain shock, the stock price will be extraordinarily sensitive.
Right. If institutional algorithms panic over shipping lanes closing, they will dump high beta, unprofitable tech stocks first. Ouster will feel that macro shock 3 times as hard as the broader market.
Which feeds directly into the second major risk, the profitability timeline. They are currently burning cash to fuel hypergrowth, operating with a net margin of negative 30%.
That strategy is widely accepted by Wall Street, but it is entirely predicated on the assumption that the hypergrowth will continue uninterrupted.
Exactly. So if a geopolitical macro shock delays the physical delivery of their sensors, or if a global recession causes their clients to delay their own physical AI rollouts, that 57% revenue growth suddenly stalls.
And the moment that top-line growth stalls, the path to profitability gets pushed years into the future. Suddenly, that massive $375 million cash runway starts looking a lot shorter.
Management is executing incredibly well right now, but they are walking a very high tightrope. They have to outrun their own cash burn. Any hiccup in execution creates a real fundamental threat to the valuation.
So, synthesizing everything we've unpacked today, it comes down to a complex equation of immense potential versus structural risk. You have the momentum of a bespoke 2x leveraged ETF and strong institutional upgrades, counterbalanced by the extreme volatility of a 3.33 beta and severe supply chain vulnerabilities.
The technological moat is undeniable. By leveraging CMOS silicon, they have solved the scalability bottleneck that plagued legacy LiDAR.
So here is the final verdict for you. Ouster currently holds an 8 out of 10 bullish score. It represents a highly compelling risk-to-reward setup, but strictly for a long-term view. We're looking at a 12 to 18-month target horizon to really capture the scaling of these global physical AI deployments.
Right. And as a reminder, we are not telling you to buy, sell, or hold. You must be able to stomach the inherent violent volatility of an unprofitable hypergrowth stock and remain highly vigilant regarding those geopolitical supply chain choke points.
It is definitely not a trade for the faint of heart, but if you fundamentally believe that artificial intelligence eventually needs physical eyes to navigate and manipulate the real world, Ouster is currently standing at the very front of the line to provide that infrastructure.
They really are building the sensory organs of the future.
And that actually leaves me with a final, broader thought for you to chew on. We've spent this entire time talking about how Ouster is building machines that can accurately see and map our human world. But let's flip that perspective.
Okay.
If physical AI, autonomous vehicles, and robotics become as ubiquitous as smartphones over the next decade, driven by the digital eyes of LiDAR, how will the physical architecture of our cities naturally evolve?
That is a fascinating concept.
Right. If the primary users of our roads, our warehouses, and eventually our homes are machines that can actually see in 3D much better than we can, will we slowly stop designing our physical world for human convenience and start optimizing it for the AI? Think about what a city looks like when the cars don't need streetlights to see the road.
That is a profound structural question.
Something to think about next time you see a self-driving car mapping your neighborhood. If you find our talks useful, please consider subscribe, like, and comment underneath.
And remember to check out the VIP Algos link below in the description.
We will see you next time on Smart Wealth with Joshua.